settlement has happened. So we really haven't seen the big move in it. So I still think that we are very early in what we are seeing. But you're going to see real use case in industry, real use case in banking. So you're seeing a new monetary framework is being built up. And while some people might be getting bullish on gold, but there's something else happening. And this is not your grandfather's gold. This is something else which is being built around. And you really need to be part and understand what's going on, or else you're going to get left out. And with a digital framework and decentralization and TradeFi and DeFi and everything that's happening, you have a real framework is being built in front of you, right in front of you, with new and big winners. So when I see projects of people are working on tokenization, tokenizing unit assets, and if you look at the case of BlackRock and what they are looking to do with their fund business, real estate business, you really have a big future being built up. And this is coming from people who didn't believe in blockchain or didn't believe in these things. You can go and Google their videos from 2-3 years ago where they didn't believe in this. And then you have people like Peter Schiff. And I saw a video last night of a guy who was banging about blockchain when it was $4,000 and Peter Schiff was ridiculing him. And yes, Peter Schiff is right on gold, which is at $5,000, but look where Bitcoin has gone to at the same time. People are excited about silver has gone to all-time high. It took 40 years to go back to that all-time high. That's not how long it takes Bitcoin and everything else to go. So you can be skeptic and miss out on everything, or you can take an interest and learn.
You could be a skeptic and get left behind, or you can take an interest and learn. What is going on, everybody? Welcome back to another CYPRX video breakdown. The gentleman that you were just listening to stems from Crossbridge Capital. Crossbridge Capital is a global independent wealth management and family office advisory firm serving high net worth clients with bespoke strategies. And you guys heard directly from that gentleman from a panel discussion that took place at the beginning of October in 2025 at the London DAS Summit, mentioning that they are building a new digital economy, and digital assets, blockchain, DeFi, these crypto technologies are at the forefront of that. And it would behoove you all to really lock in and pay attention to the shift in sentiment, even though we are currently seeing a drawdown in prices. And so in today's video breakdown, we are going to be switching up the content here on CYPRX due to this video that I posted going over in detail why YouTube flagged me. The whole entire breakdown is over on the X space and on my Rumble page. If you guys care to, see why it is we're going to be switching up our content moving forward, being very careful with what we say on the YouTube space, go over on the X space and check out this video. It goes into detail with my entire conversation with YouTube support, so that way you guys can see why I was flagged and why I'm going to be changing my content moving forward. With that being said, we're going to dive into why last week we saw the total cryptocurrency market cap shed over $300 billion in value from the weekly high down to the weekly low, and what needs to take place in terms of the fundamental backdrop in order to see a recovery in risk asset sentiment, particularly focusing our attention on crypto. With that being said, hopefully you guys enjoyed today's video breakdown. We're going to dive into the private CYPRX community report. If you guys want full access and transparency to these reports, the Zoom calls, the private community discussions, the institutional deltas, and the entire backdrop of the in-depth CYPRX research in our private CYPRX Discord, you guys can head over to cyprxtrading.com. You guys can get these live updates every single day in the private CYPRX community. We would love to have you on the team. With that being said, let's dive in again, switching up our content. We're going to be really focused on quick, brief, educational video breakdowns. We're going to be very, very careful moving forward with what we say and how we go about our research on the YouTube platform. Make sure that you guys are following us over on Rumble and X, because that is where we're going to be moving a lot of our content over to. With that being said, let's dive in. So the market overview, this is a report that I wrote for the CYPRX private community, November 2nd, 2025, to prep them for this week ahead. And I'm just going to thoroughly read this to you guys so you understand the backdrop as well. The market overview. Last week, the total cryptocurrency market cap shed over $300 billion, falling from a weekly high near $3.89 trillion to a low around $3.53 trillion before modestly stabilizing into the weekend. The correction reflected a sharp reversal in risk sentiment triggered by a hawkish shift from the Federal Reserve, renewed tariff uncertainty, and persistent strength in the US dollar and yields. Now, there are a lot of content creators out there that don't cover these very important fundamental backdrops for you guys. And here at CYPRX, we are different. We give you guys the information that you need, the education that you all should be paying attention to, not the outrageous price predictions and the bullish moonboy hope, but the fundamentals, the institutional insights that everybody should be focused on as investors in the digital asset ecosystem, i.e. the riskiest asset class that is available to trade. We have discussed in multiple Zoom call sessions that crypto's rally throughout Q3 and early Q4 was largely built on expectations on continued aggressive easing from the Fed into December and early 2026. That assumption was tested last week, and the markets did not like the answer. You can see a fundamental report from Yahoo Finance that goes on to talk about how Bitcoin plummeted below 109,000 after the expected Fed rate cut, ending in a buy the rumor, sell the news event. What had happened, according to an on-chain data provider Sentiment, while the rate cut was widely expected, Jerome Powell's hawkish tone during the post-meeting press conference rattled markets. The Fed chair cautioned that another rate cut in December is not guaranteed. So going over the first thing that weighed on market sentiment last week. At the center of last week's sell-off was the FOMC meeting and Jerome Powell's press conference, where the Fed delivered a 25 basis point cut as expected, but pushed back against the notion of a guaranteed December cut. Powell's tone was cautious, emphasizing the need for a data-dependent decision, especially as the ongoing government shutdown has limited visibility into key labor and inflation data metrics. Here are some snapshots from the FOMC press conference last week and some of Jerome Powell's commentary. Several other Federal Reserve officials also echoed Chair Jerome Powell's cautious stance last week, reinforcing the hawkish tone across the board. For example, Kansas City Fed President Jeff Schmidt stated he preferred no rate cut at all, urging that inflation remains too high and that lowering rates could undermine the Fed's 2% inflation goal. He emphasized that the current labor market stress stems more from structural shifts in technology and demographics than from monetary policy. Similarly, Dallas Fed President Lori Logan and Cleveland Fed President Beth Hammack, though non-voting members, both said that they would have favored holding rates steady, signaling that internal support for further easing is starting to fade. Together, their comments strengthened Powell's message that another rate cut in December is far from guaranteed, keeping investors cautious and risk sentiment subdued for now. The mixed signals, coupled with Powell's reluctance to pre-commit to further easing, sparked risk-off flows across global markets. The 10-year Treasury yield climbed back above 4.07%, and the DXY, i.e. the dollar, pushed to 99.3, and traders quickly repriced December cut odds down to 88% from a previous report of 90%. When you combine a hawkish Fed, rising yields, and a strong dollar, it almost always spells trouble for crypto. Here's why. Higher yields raise the opportunity cost of holding non-yielding assets like Bitcoin. A stronger dollar drains global liquidity as most crypto liquidity pools and risk capital flows are dollar denominated, and hawkish rhetoric from central bank speakers signals tighter financial conditions ahead for a prolonged period of time, dampening speculative appetite, especially in altcoins. As a result, what began as profit taking quickly cascaded into a deeper correction across the crypto complex. The second thing last week was the China and US trade meeting, the headlines versus the reality. Last week, markets turned their attention to the highly publicized Trump and Xi summit in Busan, South Korea, the first face-to-face meeting between the two leaders in 6 years. At first glance, headlines painted the event as a diplomatic breakthrough. Tariffs were cut on certain goods, and both nations pledged to pause export restrictions and agriculture tensions. Here you can see that report that would most likely mislead retail investors to think that we were going to see some underlying bullish recovery and risk sentiment last week. This report reads, the G2 meeting with President Xi of China was great for both countries. This meeting will lead to everlasting peace and success, with a little tiny snapshot of Trump smiling happily. However, here at CYPRX, we always dig a little bit deeper. Beneath the surface, the deal fell short of addressing core structural issues, such as technology transfer restrictions, rare earth dependencies, and intellectual property disputes. Key outcomes included, and you guys can see some of the verbiage in the fundamental backdrop here. If we scroll down here, A 50% reduction in fentanyl-related tariffs from 20% to 10%, a temporary suspension of rare earth export controls by China for 1 year, a tariff rate cut on Chinese goods to 47 from 57%, and renewed agriculture trade with China agreeing to resume soybean purchases. But the tariff rate remains historically high, and many thorny issues, including NVIDIA chip exports, TikTok, and Chinese purchases of Russian oil, were left unresolved. And like I said, you can see that in the headlines. These are the details that you're going to want to focus on and not just the headlines. It says here. That said, frictions will not go away entirely as several bilateral issues core to the US China rivalry remain outstanding. Also noted, it says while the trade truce is welcoming news, any indication of addressing underlying structural matters of concern is missing, such as China's industrial access capacity and non-market economy practices, said Wendy Cutler, Senior Vice President at Asia Society Policy Institute. That means that the trade truce is fragile and tensions are certain to heat up again. That fragility was reflected in markets. Despite positive headlines, risk assets like crypto failed to rally last week, with investors viewing the truce as a temporary window dressing rather than a genuine de-escalation. On top of that, we also had the Bank of Japan adding to global policy uncertainty. So, adding another layer of volatility last week, the Bank of Japan held rates steady but leaned more hawkish, signaling readiness to hike if inflation pressures persist. Governor Ueda emphasized that tariff impacts, food inflation, and overseas uncertainties remain fluid and could justify tightening later this year. Here you can see that in the headlines, the prospect of a December rate hike is still on the table. And he also, in his commentary, mentioned uncertainty surrounding trade policy and their impact on overseas and U.S. economies may have diminished somewhat, but are still there for the time being. The Bank of Japan shifts those subtle matters because it narrows yield differentials and potentially unwinds yen carry trades, a key source of global liquidity. This alignment of a hawkish tone from both the Fed and the Bank of Japan amplified global risk aversion, particularly in speculative sectors like crypto. On top of that, we had the broader macro environment and the role of uncertainty that is at play. So between the Fed's tone, lingering trade tensions, and the government shutdown, investors are still flying blind. The shutdown, now the second longest in U.S. history, has disrupted the release of major economic data, leaving markets to rely on alternative indicators like ADP employment, consumer sentiment, and inflation expectations this upcoming week. Adding to the pressures, corporate layoffs are becoming more visible. For example, Amazon announced last week that it would cut 14,000 jobs globally, with more reductions expected to continue in 2026. This combination of softening labor sentiment and missing official data has deepened unease among institutional investors. Fed officials themselves remain divided. As we mentioned above, Kansas City's Jeff Schmid, Dallas Lori Logan, and Cleveland's Beth Hammock all signaled that they prefer to hold rates steady, citing inflation as a persistent concern. Their statements gave weight to Powell's view that a December cut is far from a foregone conclusion. Meanwhile, the only inflation data available during the shutdown so far was September's CPI, which came in at a 3.0% year over year, slightly below expectations, but still elevated nonetheless. Powell estimated the missing PCE, the Fed's preferred metric, would likely print around 2.8%, keeping inflation above target. This upcoming week ahead and key events and market scenarios that we all as investors in the digital asset ecosystem should be paying attention to. This week presents a high-stake test for both sentiment and liquidity. With limited economic data available, earnings reports and Fed commentary scattered throughout the week will drive intraday volatility. We have corporate earnings on the forefront to watch this week. We have several high-profile companies set to report. We had Advanced Micro Devices, or AMD, Qualcomm, Palantir Technologies, McDonald's, and Uber all reporting earnings. The tech sector performance will be critical. AMD, Palantir, and Qualcomm have all surged this year, making them key barometers of risk sentiment moving forward. Any signs of margin compression or weaker forward guidance could spill over into the broader risk assets, including crypto. So ideally, we would like to see continued upbeat earnings reports from all of these major companies. We also have headline risks and geopolitical sensitivity to be mindful of. So outside of the central bank commentary, we must stay alert for potential headline-driven moves. That means tariff developments between the US, China, and India, along with Canada, any ongoing Russia-Ukraine and Middle East tensions, any Taiwan or China or any semiconductor-related escalations in the headline news events. Each of these could disrupt fragile sentiment and trigger rapid continuations of de-risking if they lead to any uncertain conditions favoring safe haven. Scenarios for the week ahead. So let's go over and discuss these scenarios. This will be the ideal scenario that we would like to see this week for a bullish recovery in the total cryptocurrency market cap. That is if ADP employment data shows softening labor conditions without sparking fears of a recession, supporting rate cuts, and consumer sentiment and inflation expectations on Friday that support rate cuts. Markets could interpret that as a justification for continued Fed easing in December and heading into 2026. So we would like to see the dollar continue to weaken, yields drifting lower, and crypto starting to rekindle some losses from previous weeks, heading back towards 4 trillion. We'd like to see Fed speakers striking a dovish tone, emphasizing data dependency and policy flexibility that would further reinforce the rebound narrative. We'd also like to see positive corporate earnings from tech leaders that could restore some confidence in risk assets. And last but not least, on our radar, we'd like to see no uncertainty or easing tensions, both in tariff and geopolitical headlines, making safe haven assets like gold, yen, or dollar less appealing. The bearish scenario, i.e., a further drawdown or a continued risk-off sentiment and a deeper retracement in the total cryptocurrency market cap, would likely stem if we see Fed officials continue pushing back on rate cuts, echoing the hawkish stance of Jerome Powell, and if yields or dollar strength push decisively higher, risk assets could face another leg to the downside. That means we'll be watching for any sustained dollar strength above the $100 mark or a 10-year yield above 4.2%. That would likely trigger renewed selling pressure across crypto. Any escalation in global geopolitical tariff tensions would weigh likely on risk sentiment, and any data, especially labor or inflation data that provides dollar strength, recession uncertainty, or pushes back on the rate cut expectations could also weigh on crypto sentiment this week. In that case, we'll be looking for a retest toward October lows or even lower, cannot be ruled out as a possibility. To sum this up, going back to what the gentleman said at the very beginning of the opening of this video breakdown, I say here, while the near-term tone remains uncertain, the underlying infrastructure in crypto continues to strengthen. With institutional adoption, tokenized assets, and on-chain liquidity expansion advancing regardless of macro noise, this phase of corrective price action may extend into November, but it represents a long-term accumulation territory for disciplined investors. Here is a Wells Fargo Investment Institute report that goes on to mention that if markets are going to filter around, that it might be a good buying opportunity as the Fed is loosening monetary policy at a time when the economy seems pretty solid. We believe there is an increased chance that a December Fed meeting may result in a skipped rate cut, which could push off further accommodative rate moves into the new year and potentially to a new chair, which we mentioned above would be a negative risk-off scenario for crypto. Therefore, I personally will continue to buy into the deep sell-offs and position around long-term value zones as we move through this transitional phase, looking at these sell-offs and these risk-off periods as an opportunity to build long-term positions. With all of that in mind, remember that none of this is financial advice. Hopefully you guys enjoy these educational insights, showing you all in detail what you all should be paying attention to, giving you all a detailed macro backdrop of what weighed on risk sentiment. Instead of being the confused, uneducated retail investor, attempt to join a community of like-minded individuals that are actively seeking educational enhancement so that they understand the markets in which they are involved in. If you guys want to read deeper into our private community reports and any of our deep institutional-based research, you guys can always head over to CYPRXtrading.com. You guys can lock in with us in our private CYPRX Discord. We would love to have you on the team. As always, many blessings to you guys. Be cognizant, be aware out there, and I'll see you all in the next video breakdown.